Welcome to The Explainer. All right, let's dive right in and talk about a big puzzle for investors today. How do you get a piece of that incredible tech stock growth without all the stress and the sleepless nights that come with those wild market swings? Well, today we're going to break down an ETF that was literally designed to try and solve that exact problem.
So first up, let's talk about this classic problem, the investor's dilemma. We all know that technology is where the action is. It's the engine of our economy, but man, that engine can run really hot and sometimes really cold.
So you love the idea of tech growth, right? I mean, who doesn't? We're talking about the companies building the future, AI, the cloud, you name it. But let's be real for a second. The volatility, the massive up and down swings, they can be brutal. It's just plain stressful to watch your portfolio bounce around like that. And this is where it gets tricky, right? It feels like you have to pick your poison. You can go for the high-octane, high-growth Nasdaq 100 and hope for massive returns. Or you can play it safe with something like bonds, low stress, super stable, but you're probably not going to see a whole lot of growth there. It's a tough choice.
But what if you didn't have to choose? Seriously, what if there was a way to get the best of both worlds? To tap into all that tech innovation while also generating a steady, predictable income stream?
And that's where something called JEPQ comes into the picture. That's the JP Morgan Nasdaq Equity Premium Income ETF. And honestly, this description just nails it. It's like you've got this powerful growth engine, but it's all dressed up in a reliable income-generating suit. Now, you might have heard of its famous sibling, JPI. Well, you can think of JPQ as the more tech-savvy, ambitious one in the family. While JPI is built on the broad and more defensive S&P 500, kind of like the reliable accountant, JPQ is based on the go, go, go Nasdaq 100. It's definitely got a more aggressive, growth-oriented flavor. Okay, so this all sounds great in theory, but how does the magic actually happen? How can it possibly give you exposure to the world's top tech companies and send you a check every month? Let's pop the hood and see how this thing is built. The key is that this isn't your standard run-of-the-mill ETF that just tracks an index. Nope, it uses a very active hybrid strategy. It starts by actually owning a bunch of those big Nasdaq 100 growth stocks, but then it adds a special options layer right on top to create that cash flow. All right, let's break this down into 4 simple steps. It's actually pretty straightforward. First, the fund owns the big dogs, your Apples, your Microsofts, your Nvidias. Step 2, it sells something called a covered call option. Just think of it like this. It's selling someone the right to buy those stocks later at a higher price. Step 3, and this is the important part, the fund gets paid cash right away for selling that right. That cash is called a premium. And finally, step 4, it scoops up all those premiums it collected and sends them out to you, the investor, as a monthly dividend. Simple as that. And this is the really cool part. Think about it. This strategy completely flips the script on volatility. Instead of being something to fear, volatility becomes an asset. You're basically renting out the market's natural ups and downs. And the crazier the market gets, the higher the rent or the premiums you can potentially collect. It's letting the market's rude swings literally pay you. Okay, the theory is solid. It sounds clever. But does it actually work in the real world? Let's put the strategy aside for a second and just talk about performance. What have the results looked like? Oh yeah, it delivers. We're talking about a consistent annualized yield somewhere in that sweet spot of 8 to 10% since it started. And that's paid out every single month. That is a serious stream of cash flow, no matter how you slice it. In this chart, it tells the story perfectly. Take a huge year for tech, like 2023. The Nasdaq 100 just soared. Now, JEPQ didn't capture every single bit of that gain, but it still captured about 2/3 of it. And here's the kicker. It did that while also paying you that high monthly income. That's the growth machine and the income suit right there in action. But, and this is super important, to get that kind of smooth ride and consistent income, you have to make a trade-off. There's no free lunch in investing, right? So let's be really clear about what you're giving up to get that consistency. And here it is, the catch. In exchange for that steady paycheck, you're basically capping your upside. Because the fund sells those call options, it's agreeing to sell its stocks if they hit a certain price. So if the market goes on an absolutely explosive, face-ripping rally, JEPQ will do well, but it's just not designed to capture that last little bit of froth at the very top. But here's the thing. You shouldn't think of this as a flaw. It's a feature. This analogy is just perfect.
Think of it like a sports car that has really good traction control. Yeah, you might not win the quarter-mile drag race against a car that's just pure, raw power, but you know what? When the road gets slick and it starts to rain, you're not going to be the one spinning out.
So all of this leads to the million-dollar question. Does this whole growth with guardrails approach actually make sense for you? For your goals, for your portfolio, for your ability to sleep at night? Well, it seems to be a really good fit for a few specific types of people. You might see yourself in this list. It's great for retirees who need that monthly cash but still want some growth. It's awesome for younger folks who want in on tech but just can't stomach the crazy drops. And really, it's for anyone out there who's trying to build up some passive income streams. So that's the breakdown, and it leaves us with one final big question to chew on. In the market we're in today, with all the uncertainty and everything else going on, what's more important to you? Is it squeezing out every last possible drop of growth, no matter the risk? Or is the smarter path forward a more balanced one, a path with growth with guardrails? That's a question only you can answer.